Good afternoon, students. I am now doing an explanation for the corrections that you would have gotten back. So if you have your worksheet with you, your practice tool with you, please put it in front of you. I will go through the corrections. This is a video, so please feel free to pause whenever you need time to write down your answers, or if you need to rewind and listen to my explanation again, please go ahead. For the first question is a question on depreciation. I will run through the question with you and focus on some of the important information that you need to know. All right, firstly, you need to realize that this non-current asset that we are referring to are motor vehicles. They have also given you the accounts for the values for motor vehicles on 1st of January 2017. The business is Ming, and they have given you the cost of the motor vehicles as well as the accumulated depreciation of motor vehicles. They have also told you that on 1st of February, which is in the next financial year, Ming purchased a new motor vehicles of $32,500 and it is on credit. The question also informs you that the depreciation policy is 20% of using reducing balance method. And the all-important phrase that a full year of depreciation is charged in the year of purchase is also told to you. It means that no matter which month you bought the non-current asset, you will still charge a full year of depreciation. These are the questions. The first few questions relate to theory questions, so you may pause and check your answers. Most of you are able to define depreciation and state the causes, so I shall not focus on that. C, the question asks you to write down the journal entry that Ming uses to record depreciation. Now, most of you are able to write down the two accounts. So you do know that depreciation expense increase, and you also know that accumulated depreciation increase. However, you did not write down the debits or the credit. So you need to specifically tell me that for depreciation, this account is debited, and for accumulated depreciation, this account is credited. A point to note is this: the question is only asking for journal entry, and they do not require you to provide the value because there's no need for calculation yet. Why? They did not give you a date. But if they gave you a date, then yes, you will need to give the value in the correct debit and credit column. The next question, question D, require you to prepare the motor vehicle account. Now, the motor vehicle account is the asset account. All right, it is the asset account, and they want you to do this for the year ended 2017 and 2018. So if I go back to the question, I notice that in 2017, I have a balance brought down of motor vehicle cost 128,000. This is the balance brought down on 1st of Jan 2017. They also tell you that in the next financial year, on 1st of February 2018, another financial year, the next financial year, Ming's bought a new motor vehicle on credit. So these two transactions happen in the motor vehicle account, but in two different financial years. So how do you show that in the ledger? Now, the motor vehicle account, the format is date account, debit, credit, balance. So firstly, for the transaction in blue, the first balance brought down, we will show it as 2017, January 1st, balance brought down, 128,000 debit in the balance column. All right. Now we have to remember that balance brought down is on the first day of the new year. So when you go into the next financial year, 2018, you will also have a balance brought down on January 1st. Next, The next financial year, Ming bought a new motor vehicle, and we are going to record this now. Since it is purchased on credit, we will record this in the trade payables Marlin Garage account. And how do we record this? We will record motor vehicles increase or debit by 32500 on 1st of February. The other account affected, which we will write in the account column, is trade payable Marlin Garage. And you will end off by calculating the balance column. To close this account, we close it off by having a balance brought down on the first day of the next financial year, 1st of Jan 2019. Many students have gotten this balance missing. You did not close the account properly. And if you do not close this account properly, you will lose marks. Right, the next question, you are asked to complete the table by calculating depreciation, accum depre, and the net book value. Firstly, you need to recall that the reducing balance method, the formula is cost minus accum depre. Hence, in the first year, 2017, the cost is still 128000. You have not bought your new motor vehicle yet, so there is no change to the cost. The accumulated depreciation is also what is given to you on the question above. So you just need to take the cost minus accum depre times 20%. Most students are able to calculate this. Now, in the next financial year, you actually bought a new motor vehicle. So this number highlighted is the new motor vehicle. Now, this new motor vehicle needs to be added to the cost. So you should take the old cost plus the new motor vehicle that is purchased. You need to deduct away the accumulated depreciation. And where does this 46080, where does it come from? It was the accumulated depreciation from last year. So you take the cost minus accum depre from last year times 20%. Apart from that, most students are able to calculate the net book value and the subsequent accum depre. Theory-wise, most students are able to do this. You are able to state and explain why a business should depreciate its non-current asset. This is really just memory work. You should put in effort to memorize the accounting theory. And with this, we are done with the first question. The second question deals with trade receivables. This question, you should take note that there are some changes to the years. So what I have highlighted, this has been changed. This might affect your answer a little bit. I apologize for this. I took this question from another school and did not realize that an error was made in the question. So I go through the question first. So Cooper, the owner of Coop Trading, provide the following balance on 1st of January 2018. So in 2018, he gave you a balance for allowance. Now, just want to remind everybody that allowance is a contra asset. All right, allowance is a contra asset, and contra assets have an accounting rule minus plus. Contra assets will reduce your assets. So allowance, which is like a reserve set aside in case your debtors cannot pay you, in case your trade receivables cannot pay you, Cooper has set aside an original balance of allowance of 4,003 at the beginning of the year. the question also tells you that Cooper reviews the list of trade receivables, and every year at year end he will do that. All right, and he estimates that 6% of the trade receivable is likely to be uncollectible. Now, this 6% is the ending balance or the estimated allowance of balance that you want. Then, now, what is this trade receivables that the question is referring to? 6% of trade receivables. The 6% of trade receivables is given to you at the next information. It informs you that in 2018 and 2019, there is some trade receivable. The last piece of information that is given to you is that on 13th of August, Melody Trading was declared bankrupt and Cooper had to write off $700 as irrecoverable. So this $700 is a write-off. Now, these three things, original, write-off, and your ending, OWE, was what I taught you last year. It's a way to calculate how much your allowance need to be adjusted every year. So the first journal entry is quite straightforward. The first journal entry, most of us got it correct. So journal entry to write off the debts, allowance need to go down because this person is now bankrupt. So you set aside some money in case people go bankrupt. So that's when you use it. So you reduce your contra asset. You also reduce your trade receivable. You minus away your asset. Because Melody Trading has bankrupt, she is never going to pay you back again. So you minus trade receivable. Most students are okay with this journal entry. Now, previously I mentioned to you that we look at original balance, write-off, and ending balance, OWE, to calculate the adjustment that we want. So in the next question, they ask you to write journal entries to adjust the balance of allowance for impairment of trade receivable for the 2 years, 2018 and 2019. 2018, I will do this first. So in class, we talked about OWE. What is the original balance? Now, if I refer to the previous question, the original balance was 4,003. And that is what I'm going to write as my original balance. I started out the year with 4,003. In 2018, I also know that I wrote off $700. All right, I wrote off $700 in 2018, and that is what I'm going to show under write-off. Minus away $700. When 4,003, my original balance, deduct away $700, my write-off, I am left with a balance at this point of $3,600. The last thing that I need to do for E is to find out what is the estimated or the ending balance that I want. In the question, it informs me that Coop Trading wants ending balance of 6% of trade receivables. So I need to find out what is 6% of my trade receivables for 2018. And how I do that? I will take 6% times 26,000, and that will give me $1,560. And this is the amount that I want as my estimated or the ending balance that I want. So what is the allowance that is required in 2018? I should take what I want, 1,560, minus away what I have, 3,600. And I will see that there was a reduction in my allowance because I have 3,006, but I don't need so much. I only need 1,005. All right, I only need 1,005, and I have 3,006. I actually don't need so much. So because I don't need so much, I need to reduce my allowance now. How do I reduce my allowance? I should take allowance minus. All right, minus what? Minus this amount. Your allowance should reduce by this amount so that my allowance will go from 3,006 and become $1,560. So the first entry I write is allowance minus, reduce 2040. The next entry I record is a reduction in my impairment loss. I have lesser impairment loss because I found out I don't need to set aside so much money. So a negative loss is like a gain. I've actually made some gains because at first I thought I would have a lot of people cannot pay me. But now, no, actually fewer amount of people cannot pay me. Instead of making a loss, I have made a gain. So a negative loss is like a gain. So instead, I will be crediting my impairment loss and crediting an expense. So this is for 2018. You may pause if you need to think about this year. In the next year, 2019, so no longer 2018, now I'm talking about 2019. In the next year, 2019, what is happening? Firstly, I have to write down my original balance again. Where is my original balance? Last year, I ended the year. Last year, I ended the year with $1,500, right? This is the ending balance. So last year's ending balance is the next year's 2019 opening balance, the original balance. Then I think about it. Did I have any write-off in 2019? If I went back to my previous question, I see that there's only one write-off in 2018, but there is no write-off in 2019. So in 2019, there is no write-off. The balance that I have now is 1,560. That is what I have. But that is not what I want. I want an estimated or ending balance that is 6% of my trade receivables. So if I do that calculation, I will find out that I want an ending balance of 2280. So how do I adjust my allowance then from 1560 to 2280? I think you will realize that your allowance need to increase. So you will take 2280, deduct 1560, and it will have an increase of $720 in your allowance. How would you record this in your journal entry? Firstly, your allowance increase, so you need to increase your contra asset. And when you increase your contra asset, you will record this as a credit. Secondly, since allowance increases, impairment loss also increase. You have more losses because you need to set aside more money for people who cannot pay you. So you will increase your impairment loss. And this is the double entry that you will record. You may pause here if you need some time to think. Finally, you are required to use an accounting theory to explain why it's necessary for business to account for impairment loss, and you can use either of these. Most of you are able to do it, so I'm not going to spend too much time on it. Let's go to the next question next. Question 3 was fairly well done, and so it's not included in this explanation. I will only record the explanation for service fee revenue. For service fee revenue, question number 4, this is the question. They have informed you, firstly, that on the 1st of January 2020, there was a commission received in advance. Now, you need to know what is a revenue received in advance. A revenue received in advance is an amount that is received last year, but it was not earned last year. All right, so since it's not earned last year, there's actually a liability owing to the customer. So that's why there is a commission revenue received in advance. This year, you will earn it. All right, because you never earned last year, this year you will earn it. They also tell you that the business receive some money in checks for commission revenue, and of this amount, $1,280 relates to work that has not been done. Now, this question, what is required of you in Part A? Part A wants you to record all transactions that is related to commission revenue, including all the closing entries. All right, so this is what we will be recording this time. Now, what do we start off first? We start off with the commission revenue received in advance at the beginning of the year first. So we start off with this first. Since we received this commission last year, but we never earn it this year, what's going to happen is that in 1st of Jan, we are going to earn this 2006, right? Last year we received the money, but we never earn it. So next year, right, we will have to work and earn the money. So we take it that on 1st of Jan, right, the business will work and earn this 2006. So this is the first entry that we will record. Since we work and we earn this amount, we will record commission revenue plus income, because we will earn this amount. And we will record minus liability. Why? Why do we minus liability? Because we have earned the income, right? We earn the income, we do not owe customer. All right, we don't owe the customer anymore. We do not owe the customer, there's no liability, we minus away the liability. Now, some of us will remember that this double entry is actually a reversal of the entry in 2019 year end. At year end, we reverse all these accounts. And we do this on 1st of January. The next piece of information that is given to you is that there is 500,000 checks that is paid to you. So all these checks that is received for commission revenue needs to be recorded in 2020. How do we record it? When I have received check, I will record cash cash at bank increase. I will increase my assets, and I will also increase my commission revenue. Last piece of information that is relevant to me is $1,280 relating to work that has not been done yet. Now, if you have not done this piece of work yet, you must know this is unearned income. You have not earned it, you don't deserve to record it now. How do I record this? I will record it here. What I will do is that I will deduct. All right, so with what happened is that this $1,280 has not been earned at year end. Since it has not been earned, right, unearned, the business should not record it as an income. And that's why you need to deduct away income and increase a liability. You owe work amounting to $1,280 to your customers. So you minus income because unearned plus liability. Lastly, what we need to do is we need to record or transfer all the earned income to your income summary. And the way to do that is to take your total credits, all right, all your total credits. So all these total credits here, your, your revenue, your commission revenue total credits, which is this. Oops. Okay, total credits, which is over here. And then you minus away your total debits, which is this amount. Total credits minus total debits. And that would be the amount that you need to transfer to your income summary. Just a reminder to us, what is a transfer of amount to income summary for? When you do that, you are actually transferring the earned income into your income summary, which will eventually go to your statement of financial performance. So here we are. You have the journal entries. Do you understand them? If you did not, please go back and review this video again. In question B, you are asked to state the amount and the account which will be reflected in the statement of financial position. So the amount that will be reflected in the statement of financial position, not performance, but not performance, but position. All right, the statement of financial position has all your income and expenses, right? So what you have here is actually your earned income. In other words, what is shown in your income summary. Next, you are asked to name one accounting theory. So your accounting theory is over here, all right, in D. Most of you are able to name and explain one accounting theory. So good job, you. Right, so this is the end of your WA practice. Let me know if you would like more practices.